Very good afternoon, everyone. Welcome to today's uLaw webinar. The topic for today's webinar is Trust and General Reconciliation Demystified. This particular webinar has been accredited for 1 hour of professionalism CPD credits in the provinces of Ontario, British Columbia, and New Brunswick. I do repeat, that is for 1 hour of professionalism CPD credits in the provinces of Ontario, New Brunswick, and British Columbia. So please do take this particular topic, Trust and General Reconciliation Demystified, enter it into your appropriate Law Society web portals to be able to take this 1 hour credit. At all times, as always, do use the chat window to ask any questions that you may have pertaining to this webinar, and both myself and my staff here at uLaw would be more than happy to answer that. For a better audio quality, if in case the quality of your audio on your laptop or any mobile device is not great, you do have the option to dial in using a phone number that's been provided to you both on our email as well as provided to you just now in our chat window as well. Okay. So like every other uLaw webinar, this webinar has this very specific agenda given the CPD nature of the webinar as well, and it's to simply cover the reconciliation process. One of the most important mandated steps from a Law Society compliance perspective, also gives you as a business a peace of mind every time you do reconcile your books, so that you're on top of your game, you're top of your numbers, and you exactly know what's happening with these numbers as well. So we're certainly going to talk about the reconciliation process. And depending on your individual situation at your legal firm, talk about both the trust and the general reconciliation. And I mention that because certain legal firms may not have a trust account to begin with, in which case, of course, you would not be doing these trust reconciliations as often or as mandated as the legal firms that do have a trust account you operate with. The general reconciliation is, of course, for your operating account, for your business account, and we certainly talk about the salient differences between the trust and the general reconciliation, the important data points that are need to be collected and reported on both these different documents, and how easy and simple it actually can be given today's day context and the advent of technology for your legal firm to be able to use the appropriate tools to generate these reconciliation statements and conduct these reconciliations with a peace of mind and having full confidence over the actions that you're taking to make compliant. We'll certainly talk about a quick checklist or a guide of what's expected during an audit, more specific with regards to the reconciliation and all of the other documents that are being requested of you during an audit, such as ledgers and journals. And last but not the least, we certainly will walk you through using uLaw as an example of how you go about generating these reconciliation documents. Okay, so that's what's in store for you the next 55 minutes of this particular webinar. And once again, thank you for joining. Use the chat window to ask all your questions. Just as a quick primer for how the legal tech and how accounting for legal firms have evolved, we always start off with this initial slide so that you have a better appreciation for maybe a bit of the struggles that the previous generations probably had, lack of technology, lack of expertise in terms of the technology and tools and the cloud enablement that we have today. Starting off, of course, with a very simple manual double entry system, simple, expensive, yet depending on the nature of the transactions that your legal firm that may be dealing with, can be time consuming and can lead, of course, to a lot of manual arithmetic errors, if you will. Okay? And that system over time has evolved from that to a one-write system, and the more commonly used systems that are still prevalent today, such as a spreadsheet software that a lot of legal firms may be using, to general accounting software, and leading its way now to legal accounting software. In fact, one step further to that is legal accounting software enabled in the cloud, because now, even pre-COVID, that was the technology that was building up, where companies were investing the time and effort to build these tools so that you as legal firms can take advantage of these tools to be more prepared and handle these situations anywhere, any place, anytime. That seems to be the real mantra, right? And through this evolution of improvements that are done to the systems, the end goal, of course, is to make it easy, convenient, and hopefully compliant in nature for you as a legal firm to practice best practices to generate with confidence these compliant-related documents that are expected out of you right from the get-go. They do set that expectation that these are the set of documents that you as a legal firm would have to produce on a regular basis. The reconciliation documents that we're talking about today, it is requested as part of that compliance nature that at least you do that reconciliation step once a month, so that you have maybe a reconciliation report for your trust account for every month. You have a reconciliation report for your general account for every month, right? So 12 documents for trust in a year, 12 documents for general in a year, if you do have all these accounts in your, as part of your business. And really coming down to the last leg of technical improvements that we have, of course, the legal accounting software that's designed for legal firms that do handle with trust and trust accounting, prepares you for automatic calculations so that manual errors in arithmetic errors are completely removed. Makes it easier, of course, to do granular ledgering so that it's easier to appreciate where the money has come from, who has that money been transacted for, the client, the matter, etc. And with the cloud, the one big moose on the table, if you will, was the fact that it could sometimes be expensive, but with cloud enablement really democratizing the whole pricing model, this has now reduced the cost, because now you have cost per month, which you can sometimes take advantage of by paying for the whole year. And there are many tools available in the market that you can explore. Having set that context, we now move into really the reconciliation process. And you may, of course, already have a great understanding of this process. And for those who do know that, this is maybe just another refresher, if you will, maybe a good glance, a repeat, rinse and repeat of what you already know. Sometimes we do have students who've just graduated or someone who's just started their careers. For them, hopefully, this is an opportunity to learn. This particular webinar is being recorded and will be available on our YouTube channel for you to consume at a later point too. Okay. Now, what is the reconciliation steps or the process, and how do you go about doing that, right? So we first start off with, as I mentioned earlier, the trust account. A definition, if you will, of the reconciliation process, of course, it's an accounting procedure that demonstrates record keeping that you have internally within your firm or your bookkeeping. The records match with what's being recorded against your financial institution's own bookkeeping. So anytime a particular financial transaction occurs, you know that that money is landing in a bank or financial institution, a credit union, so on and so forth. When these transactions occur and they're being recorded against the bank, now that's their record. But it's important that you as a legal firm have the right tools and the methodologies and the process to record these financial transactions at your end too. Because sometimes there could be a bit of an anomaly between what you record and what gets transacted in the bank, be a bit of a time lapse. And if you're specifically doing monthly reconciliations, it's important that what you have recorded within your own books, whether you use a manual system or otherwise, and what the bank says needs to be compared and matched. Okay. And the whole aspect of comparing these two set of books between what you've recorded and what the bank says is essentially that reconciliation process. The reconciliation of the trust, of course, is the transactions that have occurred in the trust account. It's the same thing for the general or the operating account as well. The difference, the overall procedure is the same of comparing these two. But the Law Society requests you to generate the reconciliation report. Now, the report, of course, is a templatized document with certain key data components that are being expected by the Law Society for you to present as part of that document. Right? Each and every document, especially that's in compliance in nature, has a specific template, very specific data points in certain specific ways that are required to be captured, very important data elements that need to be reported, and understanding and recognizing what's expected makes it easier for you to prepare yourself to capture it to begin with as you go about your day-to-day life. Right? So if every document, for example, especially let's say the ledger and journal, needs you to capture the date of that financial transaction, because the bank certainly does do that automatically, so it's important that you capture the date that financial transaction has occurred according to you. Then, of course, you make it for internal teams to appreciate, and if you're a sole practitioner, for you to be able to capture that every time you enter it into your books, right? So that's just a very simple example. Of course, you have date, you have actual matter, client numbers, of course, how much of money came in, how much of money that went out, tax components, etc. Just to give you an understanding, there are certain important templates for these documents. And the trust reconciliation, we've kind of divided the overall trust reconciliation document based on the bookkeeping guidelines of the law societies across Canada. And we've kind of pretty much arrived to these four very important parts or elements of that overall trust reconciliation report. The first, as you could see right here, step one is really recording of the bank statement and the balances. The fact that we're doing this reconciliation, let's say, at the cutoff of a time period. So let's say at the end of every month. Just simple. So as of that particular date, we want you to compare, first and foremost, record what was the balance as per the bank. For example, you could see 40,000, etc. was the balance as per your financial institution's bank statement as of this particular date, August 31st, 2010. This is, of course, an example taken from the bookkeeping guidelines. So please, I apologize for the date. Overall procedure, method, template remains to be the same. Now, the second important set of data elements that the particular trust reconciliation wants to capture is the recording of any outstanding checks and deposits. Now, if you are, let's assume, writing checks out of your trust account, you have received funds in a check that needs to actually go into a trust account, we often assume that as soon as we get the money, it's automatically available in the bank. Sometimes with these checks, what could possibly happen, and this happens more than you would think it does, examples such as, let's say you receive a trust check, let's say a retainer, and you've got that $1,000 retainer as a trust or as a check from your client. Ideally, you should have dropped that check in your bank, or of course today there are, depending on the financial institution, you may find more, better, faster ways to do that. But let's assume you do have to walk in the bank, wear your mask, and deposit that check into your bank account. Only after you've actually done that will it reflect in the bank. Sometimes it may reflect in the bank with the date being a day or 2 days later than you've actually received the money. Let's assume you forgot to deposit that check. You said, it's a Friday afternoon, why don't I do it on Monday, or why don't I do it the next week? And for whatever reason, maybe there were a lot of clients for you to deal with, other things that you have to deal with. You left that check in your wallet, your purse, left it in the office, and you forgot about it. If time comes to end of February, and if you want to do a reconciliation, assuming that you've recorded that $1,000 has already come in, you were really good at the books, internal bookkeeping, you entered it into your system, you said, yeah, I got the $1,000 from this particular check, 1, 2, 3, 4. But in reality, you have not yet deposited that $1,000 check in the bank. So when you try to reconcile, which is when you try to compare your own bookkeeping financial records with the financial record keeping of the financial institution, very straightforward, you're going to see that the bank is $1,000 less from what you have in your own bookkeeping. Right? So, likewise, the other way is possible too. Let's say you wrote a trust check, and you wrote from your legal office a check for, let's say, a court fee or an application fee, or maybe a refund of the retainer, right? So you used 85-90% of the retainer, and let's say you're refunding the remaining 10% because you didn't need to use it. In your own books, you've recorded that, let's say, $500 was the refund. I've already recorded it at, $500 is supposed to leave my bank because that's what I owe my client back. And you wrote that check, and the client has not yet deposited into his or her financial institution, in which means the $500 has not yet been taken out of your trust account, right? In which case, when you go to compare your own bookkeeping with your financial institution's bookkeeping records, straightforward, you're going to see that the bank has not yet reflected, and hence the bank is going to have $500 more than what you have recorded in your books. So these are two very simple, but an occurrence that happens more often, and that's why there's a separate section for you to capture the outstanding checks and deposits. So these are what those two aspects are. One, it's not yet touched the bank, positive or negative. So as part of this trust reconciliation, when it comes to Feb 28, these are two important items that you do have to compare. Okay, so there's no need to panic. All you have to do is on 28, you realize, okay, yes, it is what it is. That $1,000 never hit the bank, but now you make that into this record keeping by saying there is an outstanding deposit of $1,000, and you pretty much note it down. Because the bank balance, plus or minus the outstanding deposits and checks, should pretty much now come down to your overall trust bank balance, comparing with your books. Okay. Step 2, recording of all the outstanding checks and deposits, and sometimes even bank errors. This is something we often find, especially if you've just started your business, and sometimes you do have to tell your bank or financial institution, especially you have trust in general, you need to advise them not to take away any bank fees out of your trust account directly. It's important that the trust transactions are primarily client related. If they are taking that $6 or $10 for bank fees, that they do so out of your operating account or your general account. And for whatever reason, if that $10 was taken out of that trust account, that's something that you may have not caught unless you're doing reconciliation every week, every day, so that you're closer to those transactions with the bank. Let's say you're only doing it once a month. If you do find that on the 27th of February, that particular bank error occurred in the trust, then you report that as well as part of the reconciliation process. When the auditor looks at it, they understand, okay, yes, so there were some errors and there were some outstanding deposits, and that's why there is this difference when I compare my internal books to what the financial institution's book says. So this is really the explanation for any difference that there may be between these two bookkeeping. Okay? I think that's an easier way of putting it. This is really the explanation for why there's a difference, if there's any. Now, step 3 is a very integral and very important component of the trust reconciliation report. And this is a complete list or a recording of the client's trust listing. So this is every client who has an outstanding trust money sitting in their individual accounts. And the way they expect you to report it is based on the client name, the last activity date. So when was the last time that anything happened with regards to this client's trust account, deposit or otherwise, right? And as of this particular reconciliation date, what is the amount? Because a total summation of all your client's trust balance is really what should sum up to your overall reconciled bank balance as well, right? After all the pluses and minuses. That's why the 1700 needs to match. The fourth step is exactly that, comparing the total reconciled trust bank balance, which is what the financial institution says, coming from here. So you had 40,000, but there's outstanding checks of $39,000 and an outstanding deposit of $250. In fact, there's even a bank error of $9. All that reduced leaves you with 1,700. And if I add all of my trust outstanding for all my clients, so Peter Piper had 1,100, Susan had about $72, and about $500 for Terry. When you add those, you have the same $1,700, 15 cents. That's what's being reported in the step 4, which is comparing the bank's bookkeeping ledger with your own internal trust ledger. So these are the 4 data elements of the reconciliation report. Okay? Once again, I repeat, step 1, the recording of the bank statement and its balance as per this particular date. So that's very important. What's the balance as per the date that you're reconciling? Step 2 is recording outstanding checks and deposits and bank errors. So are the reasons, if any, for a difference between your own bookkeeping and the bank's bookkeeping numbers. Step 3, especially for trust, is a list of your client's trust listing with the client's name, the last activity date, and the actual amount as per that reconciliation date. And the fourth, of course, is the trust comparison between what's left in your bank to what your internal bookkeeping says as the balance of the total amount for the unexpended balances client's trust ledger. Now we directly jump into looking at your general reconciliation. Often we do see that the amount of importance, the amount of sensitiveness that's provided to these trust reconciliations sometimes are not provided to general reconciliations, but we believe that it's very important and critical to the success of your business, especially for you to have a top handle on the exact hygiene of your financial numbers for business by conducting these general reconciliations as often as you would do your trust. Okay? Because if you can reconcile your general account, then you can be very certain of the revenue and expenses that have occurred in that time period, and hence the P&L that you report for that time period are going to be very prudent because you have really dealt with the exact numbers and the exact transactions that have occurred and touched your general account. And you can notice there's one step less in terms of the overall data element within a general reconciliation document, and that is there is no need for a trust listing, which was otherwise needed in our step 3 is what's missing in general reconciliation, which is the client trust listing. But the other 3 components remain, right? So you're still capturing the bank statement and the balance as per this date. So this is a different date. So this is July 2017. But let's just take the same Feb 28 example. It is the same recording of the bank statement and its balance. It's the same looking at outstanding checks and deposits. Right? So let's say you got a client payment. It's as good as that retainer. And let's say you've not deposited into your general account. Or another classic example is you got a trust amount and you failed to transfer money over from trust to general. Maybe you got a check to do payments or disbursements, has not yet cleared your bank. So the same example applies to your general account as well. You may have the possibility of outstanding withdrawals and payments. Money either taken out or money not having yet been deposited into the bank account. Keep a record or a tab on those 2 items. Those 2 become, once again, the explanation for any differences that there may be, because that's what gets added up to your overall balance. Okay? And then the last aspect, of course, is the comparison in the bank and your own internal ledger. Just like how we had step 4, making sure that what the bank says, what you have within your internal ledgers for the general accounts are balanced. All right, so you kind of hopefully have an appreciation for what's expected out of the data elements within these 2 reports. And this is something that's expected that you do on a regular basis, as I mentioned earlier, as regular as at least once a month. There's no harm in doing this on a weekly basis, a daily basis. That just means that you're closer to those numbers as and when it occurs, and makes it easier for you to generate a reconciliation report at the end of the month if you've stayed close to those numbers on, let's say, on a weekly basis. So you have tools, including uLaw, that give you that flexibility to reconcile on a weekly basis, but just generate one single document at the end of the month as a reconciliation report. Now, to be able to generate these reconciliation documents or reports, there are certain prerequisites or important data entries that go prior to generating it. And the number 1 step, of course, is the particular date. That becomes very critical because on the date, the numbers will change. And you need to lock down on a particular month-end date, week-end date. That's the date when you start to look at all the numbers. So if it's the 28th of February, the bank balance would be the 28th of February, and so would your own books. Step 2 is, of course, understanding the bank balance. So you do need to open up your online banking, or maybe use your print of your bank balances, print of your bank statements, and look at the bank balance for your financial institution. for that particular day. Item number 2 that's required. And number 3 is ensuring you've cleared all the money that's come into that account, and hopefully you have a way to record those transactions. Understanding all the withdrawals that should have happened from that account. Hopefully you have financial transactions that report that as well. For whatever reason, if you compare the bank and your own bookkeeping and you see a bit of difference, sometimes if you're catching it early enough, you're able to do corrective steps to help yourself. For example, if you found that for whatever reason the bank has the $500 deposited into the bank account, you've just not recorded it internally, then you can right away go into your matter, go into accept client payment, and just update that record keeping so that now it's balanced. That's very simple. So you have a bank error and you catch it at the last minute, and you do need to close your books by the end of the month, then you report that as a bank error within the second section of the reconciliation, which talks about outstanding deposits, checks, and any bank errors. Okay. So we kind of talked about trust reconciliation, general reconciliation, really cutting to the chase, the data elements of these 2 reports that you do have to conduct at least once a month. And how do you go about doing it? What are the important elements that first go into before you're generating these reports? And now, of course, we talk about important reasons why you should do it beyond the need for compliance. Of course, compliance is probably a great motivating factor for you to be able to do this on a regular basis. But let's assume you don't have a trust account, have a general account. Sometimes we feel motivation is less, or the idea is that I can do this at the end of 6 months or 8 months just before the audit. There could be many different reasons to procrastinate that step. Here, hopefully, is a quick slide that can help give you that additional motivation, help you do that more regularly. From a issue resolution standpoint for your business, the reconciliation step most certainly is designed to catch 2 fundamental issues, if you will, right? It catches or allows you to stay on top and correct any transactions that you have failed to enter or reflect in your own accounting system as it compares to the bank. As I mentioned earlier, you did the right thing. You got the retainer. You took that $1,000 and you deposited it in the bank, and hence the bank reflects that. You were so busy that you forgot to enter it into your own bookkeeping system. You failed to enter the client. Maybe you failed to enter the matter and say that that $1,000 belongs to that client. That's easier done because you just have to go and record that into your system and it would automatically reflect it. The other aspect, of course, this sometimes the earlier you do it, sometimes it's easier it is to catch it, is catch any bank transactions that you may have forgotten to appropriately enter into. So you've got the retainer, you've entered it into your bookkeeping system, but you have it in your wallet, you haven't deposited yet. This is a reconciliation often is that one step that catches these 2 important issues that may happen in the reconciliation process. Okay. The second bulletin that you see here is something that we added so that you could get more flavor for this, more value for doing this important step. And that number 1 is ensuring that your accounting system is up to date. That you're fully caught up. There's a peace of mind. You know that you can be audit ready right away, doing this on a regular basis, right? There's nothing lingering in your mind of something that you haven't done. often the more you procrastinate, the more it starts to burden your head. And a lot of our customers feel very light about this whole reconciliation process because they are ready to face it. They know the steps and the methodology and the process that needs to be practiced. It's a rinse and repeat procedure. Once you have it, something that's engraved in your discipline and the monthly steps that you have to take to keep your accounting system up to date. And it does not seem as strenuous, especially if you've not been doing it for a long time. If you have 7 months of reconciliations to do, that certainly will look like an uphill task. You have to deal with it somehow, either by yourself or, of course, by getting help. Third-party bookkeeping individuals or experts can help you with that. Then, of course, you're doing that at a cost. But keeping it up to date, of course, by your own time or by paying an individual to do it is very important so that it's up to date and you're most certainly audit ready. Especially within the first 12 to 18 months of you just starting your practice, you pretty much know that you are going to be audited for your bookkeeping. And even after that too, it's just a great discipline to have for the next set of aspects. One is that you're ready to file your taxes with, let's say, the CRA, because as I mentioned earlier, when you've done your general reconciliation, that shows the money, the revenue that's come in. It shows all the expenses that have incurred. Two important aspects for your own general bookkeeping too, because that's the revenue, expenses gives you the profit and loss, depending on which is higher. But based on that P&L is what you're going to be paying your regular corporate taxes if you have, or sole practitioner, then the appropriate taxes accordingly. Eventually, you do have to pay your business tax to the CRA. And hence, doing that general reconciliation on a regular basis makes it very helpful for you to understand your P&L on a monthly basis. It allows you to also deal with your provincial taxes, your GST, PST, HST, right? Which also is something that you got to pay back to the CRA. If you are someone who needs to stay on top of your numbers and really understand how much of revenue, how much of expenses did I incur this month, what is it in comparison to the previous month, what corrective measures can I take to reduce my expenses, what marketing strategies can I use to improve my revenue, these numbers after reconciliation will pretty much be written on stone because they're prudent, accounted for, and you can be very confident of those numbers. Okay? As I mentioned earlier, you certainly have peace of mind, and many times that's priceless. And is it true that you will be audit ready if the reconciliation steps have been done? Like if you've generated the reconciliation for general and trust, are you audit ready? And we believe the answer is yes, absolutely. Because once you've accounted for these transactions between your bookkeeping system and the bank and compared it, then you don't have any more doubts. All those doubts were cleared in step 3. Step 2 in terms of general reconciliation, step 3 in terms of trust. Cut those errors, if any. You understand the anomalies, if any, and very confident as to why that there even may be a difference. Sometimes you can even move a transaction to the next reconciliation period, having that clarity through every reconciliation prior month. So yes, you are absolutely ready. And as part of your audit process, reconciliation documents are a very important starter of a set of documents that you may be asked for. The next set of documents outside the reconciliation documents include your ledgers, journals, and some provincial documents too. And for you to generate, right, your trust, general, and ledger journals, these are just a record keeping of all the financial transactions. Right? This is really the, as they say, the devil is in the details. The ledgers and journals are the details of how you receive that total funds. So if you have, in this case, let's say you have $1,120 for Peter Piper, the ledger will clearly state how much money did you get. Maybe you got, $1,500, right? And maybe the 380 was already transferred from trust to general. Detail behind that story is very well captured according to your ledger and journals. Once you've done your reconciliation, pretty much generating these ledgers and journals, and it's just a click of a button. It shouldn't take you long. And those documents encompass the final package that you need to submit or be ready with when you're being audited, saying, all right, here's my February 2021 package. It has a trust reconciliation, followed by the trust ledger, trust journal, for both my receipts and payments. Likewise, I have a package for my general accounts. So you have 2 packages, let's say at a max, for every month, with maybe 4 or 5 documents in each package. So about 10 documents, give or say, for every month. And then you're golden. Pretty much can be very confident. In fact, once you're ready, you definitely want to be audited because you want to show off how prepared you are for that process and for that exercise, right? Like anything else in life. Okay, so a story, right? A prequel to this whole aspect of reconciliation. Of course, start us, really with the discipline. How do you capture these transactions? Because we've just discussed that the reconciliation process, the ledgers, the journals are in all but capturing financial records. So to be able to report, you need to reconcile. Before you're able to reconcile and report, you need to record. And there has to be a system, a process, a methodology that's in place so that you can fall back and be very confident of those numbers and those transactions. For example, starting with your retainer letter. It all starts there. When you engage or retain your client, very clearly defining the rules of that engagement. How often do we have to disperse? How often do you have to invoice? When can you do your trust transfers? Etc. Because all that determines the nature and the cycle of the financial transactions that are being recorded. Right? And we've discussed in some of the previous webinars as well as to how important it is for you to now, because it is the early stages of the new year, for you to have an opportunity to cleanse, improve, or stay on top of the current best practices that you have to make it easier for yourself and for others in your firm to be able to have full confidence in this entire life cycle, starting with the initial client intake to the final reconciliation document being generated. Especially if you're a sole practitioner, it is your responsibility to find the right tools, services that can allow you to all of this outside of the time that you need to spend to generate revenue and to grow your business, right? So having a checklist such as this and reviewing that checklist on a regular basis gives you that confidence that you're on the right track. And if you're not, you at least can appreciate what deviations are so that you can come back on track. And we've seen this with a lot of our clients too. There could be this one area of practice that always throws them off just because of the nature of that particular business, right? And maybe that area of practice is counterproductive to the way they are used to doing business, their overall nature of dealing with individuals, their overall nature with dealing with the necessary processes that are needed the discipline that's needed. And often they find a nice compromise to say, hey, this particular area of practice does bring me revenue, but does gives me more headache than what I need to deal with. And having a quick glance at your overall checklist of the procedures, understanding your P&L, understanding where are the expenses, where's the revenue, allows you to make good informed decisions, if you will, about your business, about strategies that can actually help you be more profitable in your business. Because that's what it comes down to at the end of the day. Profitable, being successful, happy, having the compliance built right in so that you don't have to worry about it. Okay? The last slide, of course, is if time is money, and it truly is in the legal business, how much of time are you spending to generate these reconciliation statements today? Each firm, based on, as I said, the nature of the business, the areas of practice, the number of transactions, types of work that you do, varies. And again, depending on whether this is a large firm, medium-sized firm, or a sole practitioner firm, the amount of time that you have to accommodate and spend towards this varies as well. Sole practitioner, of course, limited time. The larger the firms, you may actually have dedicated staff that can help with these things, but it still needs to be done. Time still needs to be spent. And the reason for us to share this slide, of course, is if you are currently doing this in a very manual way, maybe a little bit old school, sometimes the reasons are that you don't have necessarily as many transactions as you would like, but really assess the amount of time that you do spend in these reconciliation procedures. And if you're spending a lot of time, let's say, more than what you can accommodate over a weekend or so, then you probably should rethink your strategy. Because with today's tools, and of course, investing in training yourself in these tools, because the tool alone would just not, do the job. Recording those transactions in a specific way, reporting them in a specific way is important. So you, of course, need to be fluent in using these tools and make them work for you, right? You need to be able to drive a car. Just having the car at the driveway is not going to do it, right? You need to know how to do it. Hence, having the right tool, learning that tool, putting it to use, and getting the benefit of that tool is very important. And this is 2021, and there are tools out there, especially cloud-enabled, that can reduce the amount of reconciliation time that you take today if you're doing this in a manual way. So long story short, give yourself a break, to do the right research, to find the right tools that could help you accomplish these important, regular, rinse and repeat tasks that you otherwise have to do anyways manually, but helping yourself by using the right tools can automate, if not 100%, at least a good 80% of the work that needs to get done. And if you are using a trust account, then most definitely do, in that comparison chart that you have for tools out there, most certainly start out with a legal accounting software. Cloud, non-cloud, that comes down to your individual preference, comes down to price, comes down to comfort, support, a lot of different flavors that you need to consider before choosing a tool and a company to work with. But start off with the legal accounting software because it's purpose-built to deal with trust account. It's purpose-built to deal with financial nitty-gritties of that trust account, subledgering, the various different reality anomalies that can happen within a trust account. And start off there. Find the tool, of course, through that evaluation that can best reduce the time and effort that you spend in doing these tasks. Of course, this is a slide that we've used for a few years now, and hence you see the link to LSUC, but you can most certainly Google spot audit checklist, bookkeeping guidelines, and this is something that's available for each province. So if you're in the province of Ontario, you certainly can search up LSO. Likewise for BC and New Brunswick and all other provinces, Alberta, every province, every law society in these provinces are doing a great job updating requirements and setting those expectations ahead of time so that they're not asking you for, out of syllabus document really during an audit. Because they pretty much expect you to have gone through this checklist audit so that be well prepared. But these are the same set of documents, the usual suspects, if you will, of documents that they're going to be asking for. Okay. Alrighty, so with just another 5 to 7 minutes remaining in today's webinar's time, let me shift gears, as promised, to walk you through a uLaw experience in doing the same. Okay. Being, of course, a legal accounting software, we're Canadian, based out of Ottawa. We've been doing this for over 10, 11 years now, believe it or not, serving several hundred legal firms. I'll draw your attention to our accounts. I'll start off with just showing the reconciliations process. So if I come under monthly compliance, you have all, of course, ledgers, journals, and other documents. I'll start with the trust reconciliation. The prerequisite to, of course, do your trust reconciliation, as I mentioned, is to choose the date. So let's say we're not waiting up till the 28th, doing this cutoff this Friday. So as of the 26th, right, these are all the transactions that have been recorded. Now, if I change this date, if I change this to, the 29th of January, we're going to see that there are no transactions because we reconciled the month of January. There are no more transactions that have not been reconciled for Jan. If I'm doing this on a monthly basis, let's say I do this for the week of 5th. And nothing. I move to the 12th. Yes, there are a few transactions now. So that's how that works. So you can see that these are the transactions that have been recorded in the bookkeeping system of uLaw. So this is, as a legal practitioner, I've chosen a demo account called Mr. Roger Moore, who's a legal practitioner here in Ontario, and this is his uLaw account, his bookkeeping legal accounting system, where he and his firm have captured about 10 transactions starting from the 10th of February, so you can actually do a quick comparison, till the 17th. So no trust transactions have hit this after the 17th. Okay. Now let's say we just received a retainer this morning and your clerk or the Roger Moore's clerk ran to the bank, deposited it, has not yet entered it. You will see that difference when you compare the bank balance, provided the bank has deposited and cleared it, and it's in the bank account. In which case you can just go into the system, choose that particular matter or client or add that client, go into that particular client's matter and just input that retainer to have been received. And that's how you catch the anomaly during that reconciliation. Okay. Let's say, let me generate it and walk you through it. with trust reconciliation. So we capture the bank balance, this being a account or a playground account. These numbers are not real. The first step is to, of course, understand bank balance, as I mentioned earlier. Right? The second is to understand if there are any outstanding withdrawals and receipts. And to do that, you're going to clear these transactions because these are those transactions that are in question. So on the 10th, I've entered, or somebody in your firm has entered, there was a $1,000 retainer for this client, Thompson Ford, for a matter 918346 that was received through this check 767. Now you have an option of choosing the bank date and confirming if it was exactly on the same 10th that the bank reported to be. Now, if you have your financial institution, your bank statement, and it says it's the 11th, you can clearly change the date. So the date is the bookkeeping date, and the bank is the financial institution's date. Likewise, you can go on to the next one. It says $200 was withdrawn from this trust account to a disbursement payout from trust for that same client. What it says is you used the trust account to pay for that disbursement, which was an application fee. Again, you're going to check, was this $200 reflected in your bank? Well, let's say that application fee was still not, then you're going to leave this empty. You're going to want the next transaction because that $200 now gets accounted as outstanding withdrawal. Right? So on and so forth. You change the date, validate those transactions that occurred, exist between both your bookkeeping and the financial institution, one at a time. And you notice that there are no outstanding withdrawals or deposits. So if this 200 were not to exist, we uncheck it. That would be the outstanding withdrawals and payments. Right? And hence, the bank would have $200 less. Right? So it's important for these transactions to match. For you to be actually able to reconcile. And in fact, you don't even have to generate one single document every time. If you're doing this on a monthly or a weekly basis, you can even generate a weekly preview. And once you've previewed it, when you come back the next week, it's a ripple effect. Automatically, the system would show you that you've already accounted for all these transactions. You don't have to review them one more time. You can blindfoldedly check them off. Once you've done that, of course, you're going to generate a reconciliation document. This is for the month ending for February. Pretty much done your February reconciliation. Here it is. Here's your preview document. You can see the first document that we generated was a preview. It's something you can do on a weekly basis to get caught up. Instead of waiting till the end of the month to catch up on, let's say, 40 or 50 transactions, you can do 10 a week as and when they occur. And be confident of all these numbers having already been dealt with so that the last week you're only dealing with the 10 transactions that are unique to that week. Okay? The template is the same. You first have step 1, which is comparing the bank's balance with all the outstanding withdrawals, deposits, and the final balance, like the actual document. Okay. And then you have, of course, the reconciled and clear transactions, the total amounts. And the third step, which is important for trust, was the trust listing. So each and every client with their last activity date, and there's a color coding that we've associated based on how old they are. This is, almost 6 years old and has a different color compared to some of the newer transactions that you may have that are more recent. All this gives you the 484,861.60. As simple as that. Record the transactions, compare them with your financial institutions, make changes and corrections if you have to, write the document. The general reconciliation is the same. Look at the numbers. Check the transactions exist. Make changes if you have to. So it's 388,936.51. And you generate the general reconciliation. Of course, with that, you do not have the trust listing document. And afterwards, generating ledgers and journals is as easy as generating it for every month. In fact, if you've just done your reconciliations, you can even do these ledgers and journals during the audit, because you can be very confident that all these are just reports, right? So here you are, you have your general reconciliation. You could see it's really not having this trust listing in it. This entire list is something that's missing here. Once you've done the reconciliation, as I mentioned earlier, generating the ledgers and journals is just a click of a button. So you want your trust ledger done for the month of February, done. Because you know that the numbers behind it have already been validated. Okay. So I know it's just past 3. I don't want to go beyond this, but I certainly want to thank everyone who joined me in today's webinar. Again, repeating that the topic for today's webinar is Trust and General Reconciliations Demystified. It's a 1-hour professionalism CPD credit accredited webinar that you could enter into your Law Society portals. It is being recorded, will be available on our YouTube channel later this weekend or early next week. And if you do have any questions with regards to this webinar, any questions regarding us as a company, uLaw, please feel free to email us at support@uLawPractice.com, or feel free to visit our website, uLawPractice.com or uLaw.io. Thank you once again, and look forward to seeing you all in our next webinar next week at 2 p.m. Thank you.